Walk past any dealership on any quiet morning in 2026, and you'll see it. The glass, the gloss, the brand new SUV under the spotlights, and the little sign in the window, £500 a month. In Britain today, that number has quietly become the accepted price of adulthood. A job, a mortgage, and £500 a month for something German and grey. It feels standard. It feels safe. It feels like the thing a sensible grown-up is supposed to do. But that monthly payment is only the tip of a very cold iceberg, and what's underneath the water is the part that quietly sinks you. Let's start with the lie you tell yourself in the showroom. You think you're buying a car. You're not. Roughly 9 in 10 new cars in this country are driven off the forecourt on finance, and usually that means PCP. Here is the uncomfortable truth about PCP. You don't own that car. Not yet. Possibly not ever. You are renting a depreciating asset from a bank and paying them somewhere around 10, and for many people closer to 11% for the privilege. And PCP is cleverer than it looks. You put down a deposit, you pay for 3 or 4 years, and at the end, there's a balloon, one enormous final payment to actually keep the thing. Most people can't face it. So the dealer smiles, rolls you into a shiny new agreement, and the clock starts again. You never reach the finish line. You just keep running on the treadmill, handing over a payment every single month, forever, and calling it ownership. Think about what that actually means. The largest purchase most people make after their home, and it is losing value every second you have it, whilst you pay interest on the loss. A brand new car can shed 40% of its value in the first 3 years alone. That isn't a risk of car ownership. That is the single biggest cost of car ownership. And it's invisible because it never appears on a bill. You're not building equity, you are funding someone else's. Then comes the second blow, and in 2026, it lands hard. Insurance. The cost of repairing a modern car has climbed by around 40% in just a few short years. Sensors buried behind every bumper, cameras in every windscreen, parts that sit on a ship somewhere off the coast for months. A minor knock that used to be a £300 job is now a £1,500 job because the whole front of the car has to be recalibrated by a computer. That's why premiums spiked to nearly £1,000 at their peak, and why, for a younger driver, a Londoner, or anyone in a desirable car, they have simply stayed there. For millions of British drivers, insurance is now the second biggest line on the entire bill. Bigger than fuel, bigger than tax. £1,000 a year, gone, quietly, just in case. Now, here's where I want you to change how you see the thing sitting on your driveway. That car is not transport, it is a financial parasite, a leak in the hull, below the waterline, where you can't see it. Every mile you drive isn't just burning petrol, it is burning your future. It is a machine engineered to take your labour, your actual hours of work, the years of your one life, and turn them slowly into rust and scrap metal. It is a wealth siphon with a steering wheel, and most people feed it every month without ever once sitting down and doing the arithmetic. So let's do the arithmetic, because beyond the finance and the insurance, there's a hidden trio that nobody prints on the brochure. First, tax. VED. The standard rate this year is £200. Fine, manageable, but cross a certain line, and HMRC is waiting for you. Any car with a list price over £40,000 pays the expensive car supplement, an extra £440 a year for 5 straight years. That's £640 a year in road tax alone, purely because your car had an ambitious sticker price. It's a tax on looking successful. And note that word, list price. It doesn't matter what you actually paid. If the showroom price crossed £40,000, you're paying it, discount or no discount. Second, the MOT. Every year, your car goes in for its test, and every year you hold your breath, because the MOT is a gamble. Most years, it's a couple of advisories and a bill you grumble about over dinner. But one year, the mechanic walks over slowly, wiping his hands on a rag, and it's the suspension, or the catalytic converter, or something expensive with a German name. And a good month becomes a £2,000 crisis in a single phone call. You didn't budget for it. Nobody budgets for it. That's what makes it a gamble. Third, the premium brand trap. Here's a secret the main dealers would rather you didn't know. A simple brake change at a prestige German dealership can cost you 3, even 4 times what the identical job costs at a good independent garage down the road. Same pads, same discs, same 2 hours of labour. The only difference is the logo on the invoice. You are paying a premium to be told, once again, that you're premium. And then, if you live near any major British city, there is the newest cost of all, the permission tax. Drive an older, non-compliant vehicle into London, and it's £12.50 a day, every day, just to be allowed on the roads you already paid for through your taxes. For a regular commuter, in and out 5 days a week, that is comfortably £3,000 a year, not to buy anything, not to fix anything, simply for the right to exist behind the wheel. And this isn't only a London problem. Other cities are rolling out their own clean air charges, and none of them are going away. So let's add it all up, honestly. The finance, the insurance, the tax, the MOT, the servicing, the fuel, the charges. For a great many British households, the true, all-in cost of running that financed SUV isn't £500 a month. Once you count everything, it's closer to £700. Now hold that number in your mind, because this is the part that should stop you cold. Imagine you took that same £700 a month, and instead of handing it to a bank and an insurer, you planted it, a low-cost global index fund, inside an ISA, so the taxman never touches a penny of the growth. You do nothing clever. You pick nothing. You time nothing. You just leave it there, and you live your life for 20 years. That money doesn't rust. It doesn't depreciate. It compounds. And at the end of those 20 years, that £700 a month has quietly grown into well over £300,000. Let that land for a second. The financed car in the driveway isn't just a car. It's a house in the Midlands that you chose to set on fire, one direct debit at a time. You didn't just buy a vehicle. You bought it instead of your own freedom. And the receipt is sitting outside your window with alloy wheels on it. And that's the feeling, isn't it? The moment the direct debit hits the account and something in your stomach tightens, just slightly. The quiet realization that you spend the first 3 days of every working month laboring purely to fund a metal box. A box that sits, completely motionless, on your driveway for roughly 23 hours out of every 24. You are not really the owner, you are the employee, and the car is the boss. So what do people who are genuinely wealthy actually do? Because I promise you, it is not this. Real wealth in Britain is quiet. It doesn't shout from a forecourt. It looks like a 5-year-old, fully paid off Volvo, a sensible Toyota that will run for a decade without a word of complaint. The genuinely comfortable people, the ones out in the home counties, in the nice villages, with more in the bank than you'd ever guess, they buy at 3 years old. They let the first owner absorb that brutal 40% depreciation, take the entire hit on the chin, and then they buy a barely used car for a fraction of the original price. And then they simply drive it, calmly, into the ground for 10 years, owing nobody anything. No finance, no balloon payment, no treadmill, no knot in the stomach when the MOT comes round, because there is no bank breathing down their neck and no agreement to protect. That is the entire move. That is the whole secret. It isn't exciting. Wealth, real wealth, almost never is. So here is the line I want you to carry with you the next time you're standing under those showroom lights, half hypnotized by that £500 a month. A car is a tool for transport. It is not a trophy for status. And the moment you forget the difference between those two things is the exact moment it starts quietly costing you your future. There's a simple test for it too. Add up everything your car takes from you across a year. The finance, the insurance, the tax, the fuel, the charges, all of it, and hold it up against your take-home pay. If your total car costs are eating more than 15% of what you actually bring home, then somewhere along the line, something has quietly gone wrong. Because at that point, the car isn't serving you anymore. You are serving the car. If this video helped, make sure to like and hit subscribe. See you in the next one.